This is vocabulary for the Stock Market Explained, and this is episode 7 of season 1 of the Netflix series Explained. And I am Andrew Bell. Killing it. When you are killing it, you're very good and successful at what you're doing, at something. Notice here on the left of the vocabulary, killing it, there's a time, the timestamp. This is the time when this phrase appears in the video. So these timestamps tell you where you can find the words in the video. Go public. Go public is to offer and sell stock in your company and no longer be a private company owned by one person or just a few partners. And when you go public, you do that with an IPO. IPO is an initial public offering, and this is the first time that a company gives people the chance to invest and buy their stock. Dividends. There are two ways that you can make money with stock. The first way is to buy the stock and hold it and wait for the value of the stock to go up or appreciate, and then sell it. And then you make that money. The other way that you can make money, the second way that you can make money with stocks, are dividends. And shareholders, people who own stock, can receive money from the company, sometimes on a yearly or annual basis, and sometimes on a quarterly basis. A year has 12 months, and every 3 months is called a quarter. So some companies will send shareholders money every quarter, and some companies will do it every year. And this is from profits. When the company is doing well and they make money, they share it with the shareholders, and that's called a dividend. Not all companies give dividends, some companies do. Okay. Big kahuna. In English, this is a very important person or thing. It could be a top person, a top company. Originally, it comes from the Hawaiian language, and it meant a shaman, which is a spiritual or traditional healer. Often herbalists, they work with herbs, and sometimes they're in the middle between this world and the spirit world, and they contact back and forth. That's a shaman. Nasdaq is a stock exchange or place where mostly technology stocks are bought and sold. And that's compared, for example, to the New York Stock Exchange, which is a different stock exchange. Indexes. Indexes are a measurement of part of the stock market that follows the performance for selected companies. Basically, index funds are a simple way to invest in many companies at the same time, instead of just one or two companies. Instead of just one or two companies. And an example of that, a famous example of an index, is the S&P 500, which is Standard & Poor's 500, the S&P 500. The S&P 500 index contains 500 of the largest stocks that trade on the New York Stock Exchange and Nasdaq, making it a tool to measure the overall health of large American companies. Another index is the Dow. This is a stock index that measures 30 of the biggest, most important companies in the USA. Call the shots. Call the shots is to make rules and important decisions. And the person with power is the person who is able to call the shots. Shareholders. Shareholders, people who bought and owned stock in a company. And down below, and let's just jump to that, we have stakeholder. So we compare stakeholder to shareholder, not the same. A stockholder is a person who owns stock in the company. A stakeholder is someone that has an interest in a company and can either affect or be affected by the business. The primary stakeholders in a typical corporation are its investors, employees, customers, and suppliers. But it's not just limited to that. Essentially, everybody is a stakeholder in a company because the behavior and actions of companies affect everybody. If a company is making pollution, right, and if that impacts your health, then you are affected by the actions of that company and you are a stakeholder. So just comparing the pronunciation, the one above is stockholder, and then this one is stakeholder. All right, so let's go back to, actually, sorry, shareholder. Yeah, you could be a stockholder, shareholder, stockholder, same thing. And then stakeholder is the person who is impacted by the company. But primarily we say shareholder. You could also say stockholder, but the primary term is shareholder. But stockholder, shareholder would be the same thing. And stakeholder is the different word. Heyday, the most popular or powerful moment for a person or organization. Also kind of called the zenith. Let's add that here. It's the high point. The zenith. It's the moment in time where you are at the top of your power or popularity. Stewards. Stewards are protectors of something, like parents to children. And in the video, they were talking about how corporations used to be stewards and they cared more. Right now, their focus is primarily on profit, making money. There was a time in the United States in the 1950s and 60s where corporations saw themselves as stewards, and their interest was larger than simply making money. It was helping the country, helping their workers, helping build the middle class. And that all changed, according to the video, in the 1980s. S&P Index Fund. Previously, we were talking about the S&P 500, which is the index. Now we're talking about S&P Index Funds, which are investment vehicles. They're ways that you can invest money in a company, which will follow that index. So if you invest in an S&P 500 fund, they will essentially look at what those 500 companies are and invest your money in those companies for you. So this is a way to make a single low-cost investment with one company that will buy the stocks of 500 companies for you. .coms. This comes from the name of a website, so you could have CNN.com, right? But .coms refer to, in general, internet or online businesses. And then, very famously, we talk about the year 2000, where we had the internet bubble, where the value of the companies was increasing tremendously, and later the bubble burst, B-U-R-S-T. It burst, and that was the dot-com bubble. Stock buybacks. Stock buybacks is definitely something that's abused. And particularly today, it's almost a trick. It's a way for companies to make it look like they're doing much better than they really are. So a stock buyback, the process of a company buying their own stock to artificially reduce the supply and make the price go higher to increase profits. So it's basically kind of like fake money. The company is not doing better than they were. This is what they're doing, and they're making this much money. But they take that money and they buy their own stock, right, which reduces the supply, which makes their stock more valuable, but they're not a stronger company than they were before they did the stock buyback. It's just kind of smoke and mirrors. Smoke and mirrors means fake. It's magic. Smoke and mirrors. This is a way to make money without really doing anything. Hedge fund. Hedge fund, a way for a few wealthy people to take big risks and to try to make short-term profits. It became very popular in the United States in the 1980s and has continued to be popular today. And it's a big part of the video that we're watching. And I personally think it's really, really sad. I mean, it's a way for people to make money, but it's basically selling the future to make money now. So it could mean, in the interest of making money and getting profit, you destroy the company now. And yeah, you made money now, but the corporation's gone and the hedge fund doesn't care. They disappear, right? But what happens? People lose their jobs, the company's gone, and it was to temporarily get some quick money now. Hedge funds are a way of short-term profit, and very often at the expense of future profits. And finally, we have Stakeholder, which I did earlier, which is compared to Shareholder, right? And this is someone who has an interest in the company and can either affect or be affected by the business. And as I said earlier, that's basically all of us. We are all stakeholders. Okay, I hope you find this vocabulary helpful in understanding episode 7, which is the stock market explained.